All right, if you're new to the channel, my name is Mark Moss. I make these videos to change the way you think about money because almost everything they've taught us is wrong. We've been misled. And if you don't understand how to think about this properly, you're never gonna make it. But don't worry, we're gonna take these complex subjects, make them easy to understand, and more importantly, make them actionable. So what is going on with the recession? When are the markets gonna crash? The economy gonna crash? We've been told it's coming, but yet we're not here. Does that mean we're out of the woods? Well, let's take a look at it through the charts and the graph. So for right now, the experts are basically flipping a coin.
You are designated as visitors today. What is your call? Tails is the call. Tails is the call. It is heads.
50% heads, 50% tails. You win, you lose. And we are at about a 50-50. As a matter of fact, we're at about a 58% of experts are forecasting a recession. Now, of course, that means 18% are saying we will have a hard landing, but not quite into the recession. 24% of them are saying, nope, we're gonna have a soft landing. The Fed is gonna thread the needle. Now, that's 58%, a little more than 50%, but we know that it's down from 67% we're projecting a recession before. Last month, it dropped from 67 to 63, and now it's gone from 63 to 58. So the chance of us going into recession continue to dwindle down and down and down the further that we go into this. Now, we also know, of course, the Federal Reserve that's driving all of this. We have to look and see what they say. Of course, they're not going to tell us the truth. At least Jerome Powell's not. And what we can see is Powell has said he sees a very narrow path, maybe basically a very slim chance for a soft landing. So even Powell himself is saying there's a very slim chance that we have a soft landing, but the rest of the Fed staff has actually predicted us to go into a US recession. Now, I do want to point out real quickly, a recession being in the economy. The economy and the markets are two different things. I think this was made abundantly clear to you in the 2020 pandemic when the entire world was shut down. Literally, restaurants, businesses were closed, and yet markets went to a new all-time high. So it's easy to see now that the markets and the economy, the recession, are not the same thing. All right, let's keep going and look at the rest of the data. So what about the gross domestic product? So this measures how well the economy is growing. Are we producing more goods and services, or are we producing less? Now, we want to look at the growth. Obviously, they want growth in the economy. And what we can see is that the GDP measured since 1950 until today has averaged about a 9 times growth rate. You can see it in this chart right here, and we can see that productivity and production had just skyrocketed from 1950 until today, which looks pretty good. The problem is that the more debt, the higher the debt to GDP gets, the more debt they saddle, the less growth we have. It's too much baggage on your back. It's like running up a hill as somebody continues to put rocks in your backpack. And what we can see is that now we can see that the GDP has actually been kind of flat, but actually it's been going down. And as a matter of fact, we can see that since the 1960s, growth, economic growth, GDP has been growing by 4% per year. But now what we can see today, we're down to about 2% growth, which isn't good. That's not a good trend line, especially considering that we want to grow out of the debt. So we can see here from 2019, we've basically been flat. Here we are at about 2.4% growth. So there's really no way we're going to grow out of this debt to GDP trap at this rate. And as a matter of fact, the trend line of the growth is going down, and the more debt they pile on, the less growth we're going to have. Now, it's also important to understand that this is happening at the time when the Fed, the central bank, is doing everything they can to stimulate the economy. So while we're witnessing GDP growth go down, we're also witnessing the Fed's balance sheet going up. Look at that. So they continue to add more and more money, more and more debt in order to get the growth up. But at the same time as they're doing this, the growth is going down. This is the law of diminishing returns. The more debt they pile on, the less growth that they get from it, and then it starts to drag you down. But it's also important to understand this. We'll come back to this, but this is the deficit of the government. So the Fed is the central bank, then you have the US Treasury, and they are doing deficit spending. They're spending more money than they bring in. And you can see this goes all the way back to 1910. The government had pretty much always been balanced, or more or less, when you look at it from this time perspective. Here after World War II, you can see we got a little bit out of whack. But look at this deficit spending that we're in right now. So while while the Fed is increasing the balance sheet, while the government is spending so much more, we're still not getting growth. It's important to understand that. We're going to come back to that in a little bit. Now, at the same time, the Fed's been on this warpath of raising rates the fastest rate in history to fight inflation. It's been working a little bit. Now, inflation has been plunging. We can see that, or we know that the Fed's target is to have a 2% inflation number. Totally arbitrary number that just came out of nowhere. 2% is the goal though, so they only want to steal 2% of your wealth per year. Pretty good deal. What we can see though is that while their goal has been 2%, that's their stated goal, we can see that going into 2020, they weren't able to achieve it. They were like 1.5%. Going into the pandemic, CPI, inflation plunged. The Fed couldn't get enough, and so they were trying to get more. Finally, Jerome Powell said, we're just going to let it run hot. We're going to put so much into it. We're going to overshoot our target, and that's going to be okay because we're going to average it out over a long period of time. Well, they didn't just land at their target here of 2%. They went all the way to 9.1% in September of 2022. So then that was too high. Remember, it was transitory. It's not a problem. Then it was too high. So they've been doing everything they can to bring it back down. Well, they've been doing a pretty decent job, and now the latest CPI reading has been 3%. Not too far away from the 2%, which is their target. Now, if they overshot the target by this much, what are the odds that they overshoot the target and get massive deflation? Let me know in the comments down below. Now, also, I did a video in January breaking down and actually forecasting this would happen. And if you want to know why this is happening and more specifically what comes next, let me know in the comments. I'm going to do a whole video breaking that down if you guys want it. So, I told you so.
Somehow, I told you so.
A little bit. But in this CPI basket, it's a basket of goods. You have to kind of break it down and see what's inside of there. One of the biggest pieces of that basket is, of course, energy. This would be oil, natural gas, etc. And the reason why CPI has come down so much, the most dramatically, is because the energy sector in that CPI basket is one of the biggest things going down. So oil is crashing, right? That's what the headlines tell us. Oil is crashing. But you need to get a little bit of a bigger picture to really understand what's going on with oil. Here we can see since 1970, of course, when we got off the gold standard, oil had been pretty flat up until that time, of course. But what we can see, I put this red line right here. And this kind of shows us what this like medium price of oil is. And so it goes down below, and yes, it goes up above. But we kind of have this price somewhere right about $70 a barrel. Now, oil is crashing, right? Well, it's crashing because we spiked all the way back here. This is 2008. We spiked all the way here, and so it has crashed all the way down, and now it's rebounding. But it crashed all the way down to like its median price. And the reason why this is important is because all the inflation, or I should say disinflation that we've seen, is because oil went down. Oil didn't crash. Oil just returned back to normal, but now it's going back up. It's not good for CPI, but to understand this, why did oil crash all the way down, and why would it be going back up? Well, you have to understand that there's two major factors. Really, one, President Biden, the Biden administration, has been on the warpath against inflation, and this is the strategic petroleum reserves, and you can see that the amount of strategic reserves, like in case of emergency, we have reserves. The amount of reserves has pretty much remained unchanged. Here we have since like 2000, and now they've been absolutely plunging. As a matter of fact, all the way to like the lowest level since it was founded. So massive supply onto the market. But the other reason why is because supposedly when the Russia-Ukraine war broke out, the United States put all the sanctions on Russia, and all that Russian energy was supposed to disappear. Russia was going to go bankrupt, they told us, and it would disappear, and then all that oil would come off the market, which would put prices up. So everybody expected that to happen. The problem is, it didn't hurt Russia, it only hurt the United States. Russia now sets a record pace for oil drilling. They have more demand for their oil than is ever seen before. They have a record pace for drilling new rigs to get even more oil to the market. You can see in a chart right here, supposedly the world was going to sanction Russia and crush them and put them out of business. It had a small little blip on their production, but for the most part, their production has held pretty flat. So the prices spiked up in anticipation of having a massive supply imbalance because Russia's oil was going to come off the market. But because Biden dumped our petroleum reserves on the market and Russia didn't stop producing oil, they increased it, the prices haven't crashed. They've come back down to normal. Now, I have a chart that kind of illustrates this a little bit for you. It's important to see this so we can see prices have crashed. But what we can see right here in just about the last month, prices have gone back up by 20%. Now, this is a very key piece because inflation is measured year over year from month to month. And so this reading hasn't shown back up in the CPI basket, so you can expect prices of a CPI basket to continue to go back up from here. Now, what about the jobs? What about the economy? Well, we can see that sort of the same thing. Now, while we've all heard about all the massive layoffs happening, particularly in tech, and that is true, what we can see if we dig into the data, we can see a little bit different numbers. So what we can see is that, as you probably are aware, during the pandemic, technology companies boomed. Facebook went through the roof, Square, Stripe, all these different, Zoom, etc. All these tech companies took off. Amazon sales went through the roof. So they went through massive hiring to take on all the new demand for their products. But when things got back to normal, they had hired way too many people. So what we can see during the pandemic, right here, there were a lot of layoffs, okay? But then things normalized and there weren't a lot of layoffs. Now that the market is sort of like normalized and sort of back to where it was pre-pandemic, they had to lay off a bunch of people because they had overhired. And now it's slowed down, but you can see that the amount of layoffs has actually dropped back down to like a normal level. So yes, it happened, but it's sort of been contained. It's like got through it. If we look at job growth, what we can see here is, again, during the pandemic, we had a massive drop, but it's been continuing to grow. And the reason why this is important to understand is that while we did see a lot of layoffs in the tech sector, most of those were because of the massive amount of hiring that happened, and it's gotten back to normal. The second thing to take into consideration is that the market overall has had massive job increases. And the reason why it's important to understand that, we can look at this chart right here, which shows us the unemployment, of course, went up, and now the unemployment is back down, is that the broad economy seems to be doing pretty good. Now, is there danger ahead? Certainly. Could the whole thing crash? It certainly could. I can give you 10 reasons why. But as of right now, it's holding up. And what's important to understand about this is in 2000, in the dot-com boom, the entire dot-com sector collapsed. Tech stocks crashed, caused a recession. 2008, it was the banking crisis. So it was mortgages, housing, and banks that collapsed. If you were in those industries, you got crushed, but the rest of the market was okay. But it's important to understand that because in this market today, we don't have one big sector that's at risk like that. The broad market overall is doing pretty good. So while there certainly could be little sections here and there do bad, we don't see one massive problem like we saw in 2000 and 2008. Now, I'm also going to show you why that may not even be a problem as we get back to that. All right, so now that we've kind of summed up where inflation is and where unemployment is and layoffs and all those other things, now we looked at the economy. Let's look back at the markets. So what we can see is that the stocks have been completely crushing 2023, which of course 2022 was the worst financial market for stocks and bonds in over 50 years. So it makes sense that after that bad of a year, you're going to have a rebound, and that's certainly what we've had. Stocks have been absolutely crushing it. The S&P 500 is now up 20% on this year, 2023, which means we're officially in a bull market. So everybody out there worried, oh my gosh, the whole world's going to end. We're in a bull market. In bull markets, you buy dips. In bear markets, you sell rips, but in bull markets, you want to buy dips, and we are officially in a bull market until something changes, like a big recession. Until then, it's very important that you understand that you have to be in the markets that we're in, not the market you think we should be in, not the market you want to be in, but what we're in, and technically we're in a bull market. You may not like that. Like I said, we're 20% up on the year. We're 4% away from the previous all-time high that we got from that massive sugar rush of all that money that got dumped in the market. We can also see, I have a chart to show you this. We can also see here that we've gone up right here, 20% run just this year since January 1 right here. And you can see we're here 4% off of that high. Now, it's also, it is a little bit important to understand that it's really been about 7 companies that have taken the S&P 500 that high. Most of these big tech stocks that have done it, and NVIDIA has led the way right here. So you can see how NVIDIA has really broken away from the pack. The rest of these, this blue line down here is the overall S&P 500. These are the tech stocks that we have right here. Microsoft, Alphabet, and Apple. They've done amazingly well. It's also important to understand that we have a few trillion-dollar companies. Apple is now a $3 trillion company. Amazing. Microsoft, 2.5. Saudi Aramco is not a US company, 2 trillion. Alphabet, 1.6. Amazon, 1.3. NVIDIA now joining the Trilly Club, 1.1. Now we also have 2 here. They're not quite trillies. We have Tesla knocking on the door, almost 850 billion. And then we have, of course, Facebook down here, 800 billion. Maybe the next 2 companies to get to that trillion level. All right, so the stocks are doing pretty good. Now, the last piece that I want to kind of bring this home is you have to understand what I'm calling the new Fed. We have a new Fed. The Fed, the Federal Reserve, really changed its role in about 2008 when they jumped in and started doing quantitative easing, and they really started driving the markets. And part of it is because we live in this debt-based monetary system, this Ponzi system. You can't allow it to deflate. You can't have deflation. So they constantly have to inflate it. But the more it gets inflated, the more they have to act in order to keep it inflated. And so in 2008, they started really driving the markets. And then we saw it come full front and center during the pandemic of 2020, where they started creating all types of new 3- and 4-letter agencies to pump money into the markets because the Fed has constraints on what they can do, but they found workarounds. And so just when you think there's no more moves, just when you think the market's going to crash, the Federal Reserve is out, well, they pull out another move. And so we've seen that over and over. They've gone from what I'm calling being reactive to now being proactive. They don't just wait and see what happens and then react to that. Instead, they're driving it. Now we can see, I showed you this chart, I want to pull it back up one more time, so we can see in 2008 how they reacted to the market, okay? So when the markets crashed, they jumped in and pumped them back higher. But now what we see is anytime they start moving down, they automatically take action and they continue pumping that market higher. So it's a complete shift in what they're doing. Some people call it the Fed put. Now we can see, here's an article from the Wall Street Journal. This is the latest new 3- and 4-letter agency that they created. This is the BTFP. And it says here, what the Wall Street Journal calls it, the Fed's 2023 crisis facility. So they had 2020 crisis facilities, 2021 crisis facilities. Every time a new crisis comes up, they just create a new facility, some new swap line, some new program, whatever it is. And it says here, it would create a new lending program. The Federal Reserve said it would create a new lending program. Anytime there's a new problem, they create a new program. Right now, all over the news, I've even done videos on it talking about the problems in the commercial real estate mortgage market, right? Commercial real estate is a dumpster fire. I think 1 out of 5 buildings aren't paying their payments, which of course, because nobody's at offices working anymore. The small regional banks are really exposed to this. This could collapse the whole system, they tell you. Yeah, most likely the Fed's just going to take those bonds off the bank's books and put them on their own books. That's what I think would happen because this is the new Fed. It allows banks to take advances from the Fed. The Fed just fronts them the money. We're not going to let any problems come to this. And so that's the new Fed. You have to be aware of that. The other thing that you have to be aware of is it's not just the Fed. This is the government. All right, this is the government's spending and expenditures. And what you can see is leading up to 2020 right here, the US government was spending about 4.8 trillion per year on its budget for all its programs, etc. Well, that number went through the roof because, of course, all the stimulus that they were passing out, right? Well, it's come back down, but it's still at about 6.5 trillion. So the amount of money the government, the fiscal spending, went up by about 50% and has not come down. What we saw like in World War I and World War II, government spending goes up to fight the war, but then it goes back to where it was pre-war. But not in this pandemic, not in this war. The spending went up, it came back down, but it's still about 50% higher. So as long as the federal government is going to continue to spend this much money, as long as the Fed is going to be proactive by pumping money in, they could keep this market going way longer. What do they say? The markets can stay irrational much longer than you can stay solvent. So that's what's happening. That's around the world in a handful of charts. What do you think about this? Let me know in your comments down below. Is it only a matter of time, like days, before a market crashes? Because look, the market's always going to crash. It's always going to happen. We're all going to die at some point. But is it imminent? Let me know in your comment down below. Let me know what you think. Of course, as always, give me a thumbs up if you like it. If you don't, give me a thumbs down. That's okay. But at least tell me why in the comments so I can make some adjustments for you. Of course, share this video and subscribe if you're not already. And that's what I got to your success. I'm out.